In the previous lesson, I went into great detail about the value area and its potential scenarios. I introduced some new terminology of market profile, and we looked at the practical use of various setups relating to the value area. Today we're going one step further. I'll be talking about something called the day types and TPOs, what they are and how to use them. While the value area relates to looking at a previous trading day's fair value, day types will look at the current movement and today's development of price and time. Okay, market profile part 2. Let's do it. Before we begin, I will once again repeat this. Please do not try and use only market profile to make all your decisions on trade direction. Your analysis should come from Q points, first on a 4-hour and daily charts, but not forgetting the trading plan, and then looking at weekly and monthly conterminous lines, as well as the price action around those areas. Anything involving market profile is only ever an addition to that and should not be used alone to enter positions. And this is because when you can read supply and demand zones correctly, by the time you try to enter into a trade from just purely a market profile signal, especially those signals that I will be talking about here, you will largely end up with a bad entry with a massive stop when you compare that with the supply and demand levels that are previously existing around those areas, and then using consolidations and rule of fours in order to enter those levels. Market profile in my method of trading is only used to confirm the trade direction in case you're not entirely sure whether a supply-demand zone is going to work out. So only to confirm that you're not on your own, looking at a level that no one else is interested in, and then when you have your supply and demand and conterminous lines off of higher time frames like H4 and daily and weekly charts, and you know where your previous swing Q points are, then and only then, if you also see that the value area and market profile agrees with your analysis, this will give you a lot more confidence in the direction of a trade. But it should not be used to enter positions just purely on the basis of market profile. I cannot stress that enough. Okay, market profile TPO letters, the time price opportunities, TPOs for short. Like you've all noticed these weird letters on my chart, and they're all over the place, and you were probably wondering what the hell they are. It's just some bunch of letters lined up, and it doesn't make any sense, and it's like strange formations. It all looks super complicated, but I promise you it's a lot less complicated than it actually is. So I will begin by saying that each letter represents one 30-minute candle. So each of these letters is one 30-minute period. Okay? So if I go to the live chart here, you can see the letters are actually moving around as the price moves too. So there's this little red arrow, if you can see it here, that shows you where the price is on the letter TPO profile. And then you can see there's letter A, B, C, D, E, and so on and so on. And each of these letters represents 1/2 hour. They're referred to as TPOs, which stands for time price opportunities, TPOs. Why is that? Because you have time, each letter representing the half-hour period, and then you have price that shows you where the price went during a particular half-hour period. So it's very much like candles. If you imagine that each separate letter had a low and a high where the price went, But then as each new candle, each new TPO is printed, you also get that time component where you can see how long the price spent in relation to the whole trading day, because eventually this creates distribution curves that are very, very visible on the profile, which are not otherwise visible on your normal charts. As traders, we need to be aware of the electronic opening times for the main exchanges and the instruments that those exchanges relate to. For now, you do need to remember just the two main ones, which is this one, London. London starts at 8 a.m. GMT, which corresponds to 3 a.m. Eastern Standard Time. That's New York time. And you need to remember Wall Street Open, which starts at 2:30 p.m. GMT. It corresponds to 9:30 a.m. EST. So let's take Wall Street, for example. Wall Street Electronic Open happens at 2:30 p.m. London time. So by default, Blatek Market Profile Indicator is automatically set to start the New York profile at 2:30 p.m. London time. If we have our market profile set to start at 2:30 p.m., then the whole letter A will represent the time from 2:30 until 3 p.m. And to illustrate what I mean, I will go to the next slide. So let's take Wall Street, for example. Wall Street Electronic Open, as we've seen from the previous slide, opens at 2:30 p.m. GMT. Our Blatek Market Profile Indicator is automatically set to start the New York session at 2:30 p.m. London time. If we have our market profile set to start at 2:30 p.m., then this whole letter A will represent the time from 2:30 p.m. until 3 p.m. Letter B, that you can see here, will represent the time from 3 p.m. until 3:30 p.m. And so it will continue all the way with C, D, E, until we finally get the last candle before Wall Street closes. For myself in London, my last 30-minute Wall Street candle starts at 8:30 p.m. and it will end at 9 p.m., which is represented by the letter M. Okay, so that is your end of the whole day. On the Blatek Market Profile Indicator, there is also this letter O that you can see here. This represents the price where market opened, where it opened at 2:30 p.m. Okay, when the Wall Street bell started. Now, one very important thing to note is that first hour of trading, represented by letters A and B, is referred to as initial balance. And those letters on Blatek indicator are always marked in red. When you look at the market profile indicators, there will always be some kind of a distinction for initial balance letters. Whichever profile indicator you might be using, there will always be this distinction for the first hour of trading. So initial balance, or IB, is short for initial balance, which represents the first hour of trading. I already mentioned initial balance in the previous lesson, but I didn't really go too much into it. Now we're going to use this initial balance range to gauge what kind of a day type we might be looking at, or what kind of a day type might be developing. We'll be looking at whether the prices extend initial balance or not, and also how far they extend. There is also the value area, which is displayed on the TPO profile itself, but keep this in mind. While on Blatek Market Profile Indicator, the value area on the chart itself is purple, as we've seen in the previous lesson. So it's purple for New York, and it's sort of kind of hot pink for London, and I think it's light green for Asia. But on the TPO letters, we decided that if we make the value area purple, it would clash with the initial balance red letters. So we decided to go with the baby blue for value area. So if you see this here, that is the value area. But keep in mind that you can only use the value area from the previous trading day and not from the current developing day, which means that on the Blatek indicator, if I show you this chart, you'll have the closed previous day's TPO profile on the left-hand side. Okay, is here. And then you have the current developing profile on the right side. So bear in mind that the baby blue letters from the left profile are representing exactly the same area as this area here, which is represented as purple lines, but it is the same area from the left hand side TPO profile. So likewise on the developing profile, which is located here on the right side, baby blue letters are current developing value area, which is the same as the orange value area, which is the developing value area for the current day. They are one and the same thing. In order to see where the current price is on these TPO letters here, we've added this little arrow that sort of moves up and down as the real-time price moves too. If you wish to see the TPOs on the chart itself rather than here, you can press letter N for November, and then you will get this. If I'm being honest, I myself prefer to look at the letters on the right, but that's because I learned on the futures platforms where this market profile window wasn't even on the chart. It was in a completely separate window to the chart, but we've actually combined everything on this, to be able to be seen on the same chart. And it's quite easy to see what is happening. And you can even see the extensions of initial balance without even looking at the TPO letters. And I think we're so far the only company who has the value area displayed on the chart itself, which honestly makes things so much easier. Okay, so far we've said that the value area we take as a benchmark for yesterday's trading, and then we use it to gauge sentiment, is always the value area from yesterday and not the one from today, in case I haven't mentioned this already. And yes, that is sarcasm, but I do want everyone to be very clear on this. Okay, so far we said that the value area we take as the benchmark for yesterday's trading that we gauge sentiment from is always the value area from yesterday and not the one from today. So this rule applies to the value area itself. But when it comes to the TPO letters, there is another thing that we're going to be looking at. Only this time we're going to be looking at it on the current TPO profile. So we'll be using today's initial balance, those red letters that I just showed you a minute ago, to gauge sentiment for today and to see who is making the moves today. But remember that although we're looking at the current day TPO letters, that still doesn't apply to current day's value area, just in case I haven't mentioned it yet. And yes, that is sarcasm again. Moving on. With that out of the way, let's start on these day type things. There are 9 possible day types. This is the first 5. So we have non-trend, we have neutral, we have normal day, we have normal variation day, and we have a trend day. Okay, now these 5 we can guess during the developing day with quite a lot of accuracy. The next 4 are only obvious in hindsight. So we have the running profile, we have double distribution day, We have a P-shaped profile and then a B-shaped profile. Starting with the non-trend day. So remember, we're looking at these red letters. So we're looking at this initial balance to see what the day type might be. So this is what a non-trend day looks like, okay? In case that your day isn't done yet, because this one is done, we have the M letter, which means the profile is done. But in case you're looking at these red letters and everything starts printing structure and the day is still developing, but there's no extensions of the range, if you go past sort of 4 hours of the trading day, it's probably a good guess that there won't be much happening for the remaining trading day. Now, obviously, please keep an eye out on any news releases, because sometimes if you have an FOMC day, which comes very late in the day, people will be waiting for that, and then there'll be very little trading. And then once Granny Yellen kind of starts to talk, the price moves outside of initial balance. So again, it's not an exact science, and you have to be careful how long in the day we've gone through. But typically non-trend days are not really that great for trading anyways. So markets, as you know, markets are organic and they are in a constant state of flux. But, if you know that for about 4 hours in the trading day, there's still no extensions of the range and there's no releases, then you can probably make an educated guess that you're looking at a non-trend day. So for example, if you're in a trade that you've traded from a higher time frame chart, you should not really expect to see any serious movement that day. In that case, you can either choose to go do something else and wait for the next day for your swing to work out, or you can maybe simply close your trade in case you haven't gotten a move away from your entry, and then you can try again tomorrow. This will, of course, depend if you're naturally a swing trader that likes to hold positions for the majority of the move, or whether you prefer to do some guerrilla trading like me, where you're sort of jumping in and out of positions while the price is trending. Of course, this depends on your skill level too. You can do both after a few years of trading, but please don't do both if you're a less experienced trader, because mixing up swing and intraday is a very common mistake. Throughout this course, I do my best to give you all the tools to start differentiating between swing and intraday, but trading is one of those skills where you simply have to allow the neural networks to develop, which can take about 2 to 3 years. There's no rushing it. Even I only got quite good at this only after about 3 years of learning and back testing, forward testing, lots of screen time, generally examining the price movements from kind of different chart positions. I was at it for 10 to 12 hours a day. And I have excellent memory, really high IQ, and I'm naturally creative. So, even for me, it took 3 years. So it simply takes time to get some of these skills or all of these skills under your belt. And obviously it takes a lot of work to get there. Right, so that's a non-trend day. No initial balance extensions either side. Then we have neutral day. Neutral day is characterized by range extensions on both sides of initial balance, and that's what they generally look like. There's a couple of examples here. As you can see on this one to the left, early on in the trading session in period C and D, so C and D, that corresponds to the second hour of trading a particular session. The price actually extended the range to the upside, but it then proceeded to also extend it to the downside, okay? So if you look at where the open is, it's here, and it's in the middle of the whole profile. So clearly, if you were to see the extension to the downside, and let's say you happen to be short from somewhere here in the middle, you would have to limit your profit expectations to the very first demand that you come across. Because if you think about it, as it starts to extend the range to the other side, you already know that the probability of price going on some kind of a breakout trend to the downside is going to be highly unlikely on this day, because you've already had a solid extension of the initial balance to the upside. Okay? So it saves you thinking, once this lower pop to the of initial balance range happens, it saves you thinking that you've scored some kind of a home run, because a lot of people get very excited when they see this kind of a move downwards, but they never look at the profile, so they wouldn't know that there was an extension upwards. All they're seeing is like, yay, we've moved away, and then it stops, and they're left like scratching their heads why it didn't go further. It's because it's a neutral day. So by recognizing that you have a neutral day type on your hands, you can simply take profits, take your cash and run, while you leave other traders who are expecting the price to keep going down, then holding the trade for way too long until eventually they donate their profits back to the market. But you know better, because you can read market profile and you've seen that it's a neutral day. Another way to think about the neutral day is, once it extends to the both sides, it's almost like having two walls and you're bouncing the ball like in between. So if you have two barriers and you're trying to kick the ball sort of over the wall, you're not going to be able to do it because you have a wall and it's just going to keep bouncing. So in a way, it's kind of like stretching on both sides will always make it come back into the middle. Okay? Hopefully that analogy helps. Okay, moving on. Next, we have a normal day. Normal day typically extends only to one side of initial balance. And when you see that happening, the price will extend only one side by the actual size of the initial balance by one time. Okay, so let me say that again. If you have the initial balance range and then the price starts to extend it, when you see this happening, a normal day is defined by the price movement traversing downwards by the range that was established during the initial balance. So it's an equal extension of the range by one time. Okay? So if you have these red letters, so you have the initial balance, and let's say that this initial balance spans 60 pips, okay? If price starts to extend to one side, you can expect it to at least go down to another 60 pips after it's gone below this initial range, the red letters, okay? By seeing that the price continues to extend to the downside, you can then have a price point of where it might stop. So that could be your target. You could go, well, the initial balance is 60 pips. I'm fairly confident that I know what I'm looking at here, so therefore I'm just going to calculate where the 60 pips from the end of the initial balance range is, and then let's see whether there are any demands here that I can match that number to. I myself don't really use the profile for entries unless it's a value area acceptance and I'm trying to either time a swing through that technique, or I'm trying to get an intraday trade at the correct time of day. But to be honest with you, even once you do start doing your analysis correctly through cue points and conterminous lines and reading the profile, there is still a very common issue with most traders, which is exit strategies. I said in level 1 final lesson that a part of your trading plan has to be a clear exit strategy, because without it, you will never exit otherwise. Part of it is ego, where you've caught a run and you're very happy with yourself and you end up marrying the trade where you never want to leave it. And again, it's a bit of a bizarre psychological thing. it mostly stems from pride and kind of sense of achievement that you were correct on the price direction. But still, not having a clear exit strategy is the downfall of many traders, and knowing the direction but not knowing where to exit is completely pointless. All right, back to the day types. So this was the normal day. Normal day is when the price extends past initial balance to only one side by the size of the actual initial balance range. Next day type is similar, and it's called normal variation day. This is like a normal day, but except the price extends twice the range of initial balance instead of once. So, for example, if initial balance from the first example was 60 pips, should the price then extend the 60 pips below or above the initial balance and then proceed to extend, you are then possibly looking at a normal variation day that would extend that range to a further 120 pips on top of the original 60. Okay, so now ideally you also have to make sure that that kind of a range extension actually falls within your average daily ranges. And more on the average daily ranges in another lesson. Now, notice something about this profile here. If you look carefully, there's a 1 TPO pop above the initial balance. Now, if you're trading highly liquid, slippy markets, such as Forex or even crude oil, or any instrument that by default has quite a lot of movement, which obviously doesn't include stuff like e-stocks or even things like Australian dollar. So anything that doesn't move much will be more accurate with the initial balances. But for highly liquid Forex pairs like GBP yen or crude oil, a lot of the times you might get these slips where there's just 1 TPO above the initial balance. Now, if you get 1 TPO above or below initial balance, that is not a range extension. That is just markets being organic. So keep that in mind. So normal variation day is when price extends twice the range of initial balance. Next one is a trend day. The name says it. You get a range extension to one side and then it just keeps going. Like, I couldn't even fit it in the whole profile here. Trend days are characterized by very narrow profiles, okay? The way you distinguish trend days from other day types is that it won't have that thick structure. Typically, trend days never have more than 5 TPOs in a single row. So each of these is a row, okay? So you have a price, 104.77, that's one row. 104.78, that's another row. Trend days typically won't have more than 5 TPOs in a single row. In fact, a lot of them won't even have more than 3 TPOs in a row. So if you see something that's starting to print a 6th TPO, it's probably time to start thinking about your exit. Because it means that the market is now creating that structure, it's creating the distribution, and it's no longer trending. So if you caught a good run, and you've noticed you have a trend day on your hands, if you see a 6th TPO being printed, that's your exit point. That is your cue to get out. The thing is, with trend days, initial balance is generally unusually large. So technically, trend days can also be put in the category of normal or a normal variation day. But what sets them apart from the normal day and normal variation days is that they're usually very narrow and they don't have much distribution until the very end when the price settles somewhere higher up or lower down at a new chart location. The next few day types, they're not really that useful while the market is developing. But it's useful to know why they happen, because there's an underlying reason for why they happen. So this one is a running profile. Usually running profiles happen on high impact news event days. So you might even get range extensions on both sides, but then you might have something like crude oil inventories that comes up, and then there's a surprising figure, and then suddenly that sends the price into a trend because of the new information, and the markets have to reprice themselves. A similar thing with FOMC. Typically, things tend to be very quiet until very late in the day, sort of 1 hour before market close, when the FOMC minutes are happening usually, and then that can just send the prices into a frenzy. But prior to that, we had the structure of quite a few TPOs, and generally running profiles tend to happen when new information comes in late in the trading day. Next up is double distribution trend day. These are relatively rare. Like, I've seen a few on crude oil and S&P, and I've tried really hard to find you an example of this in the last few weeks. But like I said, it's really rare. This is kind of the closest I came up with. They look something like this, but usually they will have like a thicker distribution at the top and a bottom. So there will be two very prominent bellies, two distribution curves, okay, instead of the one that we usually get. Not very useful while we're trading, so again, another thing that you only notice in hindsight. Next up is a P-shaped profile. Another thing that's useful in hindsight, P-shaped days usually means short covering from the institutions. It usually happens in bear trends. And it means that those market participants who have been short all that time in probably enormous positions, they are now getting rid of their positions or part of their positions. P-shaped day can mean an end to the bear trend, or it can mean that a possible end to the bear trend is in sight. It doesn't mean that it like automatically ends because it's not an exact science, but generally it's a good idea to stop selling at this point and to review where we are in terms of swing Q points, strong daily zones, or any daily zones. So it's a little clue that things could be changing, or at least that there might be a correction coming on the cards. And finally, B-shaped profiles. They are much like P-shapes, but this time it occurs in bull trends, so in long trends, and it means that longs are liquidating. Therefore, you might want to see where we are in terms of larger swing points, and at the very least, you might want to wait and consider not buying anymore. I would like to point out another thing. On our Blatek market profile, we placed a letter O, if you can see letter O, to mark where the market profile started, where we had our open. This is something that profile traders can use after market close to determine whether the day was overall a sell day, a buy day, or a neutral day. Jim Dalton calls this a composite day analysis. It can be sell day, buy day, or neutral, but to avoid any confusion with people thinking that this is some kind of a signal, we are calling it a down day, up day, and neutral day, but it is composite day information, and this is where it's located. Okay, so on the previous day, it's here. So previous day was neutral, if you can see here, and let's say today's day was down. So it was a sell day, composite sell day. So how do you look at composite day? It's basically splitting the profile into fours, into quarters, and then looking at in which quarter the market actually opened, and then gauging whether it's up, down, or neutral by the location of the open after the day. So if the open was in the top quarter of the profile, then it's considered a composite sell day. If the open was in the bottom quartile, then it's considered a buy day, and if it's in the middle quartiles, then it's considered a neutral day. Okay. I myself kind of think that this part of market profile is less useful because anyone with sort of even half functioning eyes can see whether the day was bullish or bearish. But sometimes it can give a little indication that perhaps market participants are no longer sure of the trend, and it can indicate waning momentum. So for me, if you have a neutral profile and you've kind of reached a supply area and you're looking to sell, perhaps looking at a neutral composite day afterwards is a sign that the market participants are also no longer sure whether this needs to go up. So if you combine this with sort of bracketing value areas and the supply and demand zones, which is something that will go in the next lesson of market profile, it's like with anything. You have to combine this information to see where the price is in regards to chart positioning and to see whether it tells you anything. Either way, honestly, I myself don't really pay much attention to it, but on our market profile indicator, all that information is displayed in this bottom section should you wish to make use of it. Now, practical application of day types. Once a range extension happens, your choice of what kind of a day we might get gets significantly lower. Range extension early in the trading day is less reliable, but you might guess that maybe we can exclude the non-trend day, because in non-trend you have no extensions. As the day progresses, you can see the price continuing to move away from initial balance, and then you can make a further guess and exclude the possibility of a neutral and non-trend day, which really leaves you with three choices. So you have normal day, maybe you'll have a normal variation day, or possibly even a trend day. With trend day, you don't really know how far prices will go, and considering that markets usually trend only about 30% of the time, a trend day is actually something that is outside of the normal market behavior. So you should really focus on normal day and normal variation day. And here's how you could possibly use these for targets. You can cross-reference possible normal and normal variation prices with existing supply and demand zones. So you would take the range of initial balance from, for example, from high to low, and let's say that it's about 40 pips. And since you should already know which direction you want to go, you would either add the 40 pips to the top of initial balance for longs, or you would subtract the bottom of initial balance for shorts. For normal variation targets, that would be 80 pips, because you will be looking for a double initial balance extension. So that way you have a possible target for your presumed trade. However, and now you would need to cross-reference that with the existing supply-demand zones. And I myself first use a 4-hour chart and then the daily chart. Following that, I will also scan through different time frames, including H1 and 30 minutes, to make sure just that I'm not missing another smaller supply-demand zone that could be in the way to my targets that I'm basing on this day type extension. If you're indeed looking at a trend day, just in case you do find yourself in one of those 30% days when the market is unidirectional for both sessions, in that case you need to pay attention not to have more than 5 TPOs on any row. In fact, I'd probably go as far to say that if you get the 4th TPO, it's likely the trend might be slowing down. Now, if you do see the range extension, you also need to pay attention to how sustained this move is. And we'll be covering this in a lot more detail in the next lesson of market profile. But for now, make sure that you know that should a range extension fail and the 30-minute candle ends as a reversal candlestick, such as a shooting star or a hammer, it is likely that there is no momentum to take the price that way. Okay? And we'll look at these returns back into initial balances in the next lesson. That is another way that we can gain confidence in the trade direction. I mean, market profile can give you a lot of the clues of possible outcomes, and it really takes out the guesswork. It's the first part of watching what the market participants are actually doing. When it comes to studying market profile and learning how to read it, I would probably give yourself at least 4 weeks to grasp just the value area scenarios first. Then I would spend a couple of weeks for these day types, and then another couple of weeks for the next lesson. It's a lot of info to process. Intraday trading is the highest form of skill in this line of work, and you have to pull a lot of different information together in order to correctly identify trading opportunities with high accuracy. But please keep in mind that this kind of skill does take a couple of years to really get like natural with it and to be able to use it consistently. It's a lot of hard work, but it is what it is. Whoever wants to do this job professionally and consistently, you got to be at the top of your game, like every single day. You got to be prepared, you got to be mentally strong, physically fit. Intraday trading is the hardest way to make money, but once you do get there, it is incredibly rewarding and can give you day-to-day income where you can then trade, swing for wealth. And after that monologue, let's carry on to the final part of the lesson. So this is another thing, another concept from the profile that kind of pertains to this lesson, but will also tie in nicely to the next one. And that concept is single TPOs. Single TPOs sometimes are called single ticks. They are lonely single letters that don't have a row. Okay? If you see this one, C, it's all by itself. D, it's all by itself. So when you see an initial balance extension, you will typically at first get these single TPOs. If the reaction is truly sustained, then those single TPO letters that you see here in C period should remain intact. These are all 30-minute candles. So each of these letters represents a 30-minute period. So there is no rush. You don't have to spot stuff in seconds. There is usually at least an hour before you have to make a decision on what to do. Okay, so we're ideally looking for price to move away from initial balance and to stay away from initial balance upon extending it. Once you get that, like in this example, so if you now take a look at what these candles look like, they're 3 strong bull candles, okay? While that's happening, the profile's printing single TPOs. Now, if I push my Blatek backtester time machine slightly forward in time, there's still the same chart, but sometime later. If you look carefully, those single TPOs from the C period are actually getting chewed up by D and then an F period as well. So if you look at here, we had these single ticks, yeah, and the price was 112, where the last single C single TPO was located. Now, once you see that 112 price being eaten up by the F period, that means that whoever initially bought this is no longer around. They took their money, they went to the pub. They're no longer there. So eventually, if I push the Blatek indicator time machine even more forward towards the end of the session, and if you notice what's happened here, it was a full retrace. Eventually, the whole move retraced back all the way into initial balance and closed the M period, the final candle of the profile, back inside initial balance. What I can extrapolate from this example is that if you're looking for an extended move away from initial balance, if price starts to take out these single TPOs, that is also a sign that there is no sustained reaction. Typically, I would give it about an hour, hour and a half, maybe 2 hours to decide. way before the price actually returns to initial balance. So return to initial balance following 2 to 3 30-minute candles is a bad sign for any kind of a sustained move. You don't want to see a return into initial balance. All these are little clues that can help you discern exactly what is going on behind the scenes so that you can be impartial when deciding on whether to stay in a trade or whether to bail. But all of this requires a calm, organized trading mind, and it will take time to hone the skill. So keep going through the lessons, pause, go back, listen again, pause, go back. One awesome thing about all the Blatek indicators is that it has this backtest mode directly on the chart. And while it won't erase the candles from the chart, it will go back in time to show you exactly what the profile looked like weeks, even months ago, at a particular 30-minute candle at a particular session, okay? And you can even combine that with the Blatek supply and demand indicator and with the average daily range indicator. Both of them from Blatek have this backtest mode, and they work in unison. To me, this is an invaluable tool when I'm kind of testing tweaks to my strategies. Okay, so that's it for the lesson on TPOs and day types. In the next lesson, I will be taking you through market profile time frame transitions. It is sort of a cherry on top that will enable you to really know who is making the market moves in relation to what you now know about the value area and the initial balance range extensions. But please take your time, don't rush. These are complicated concepts to understand. Once we're done with the profile lessons, we're going back to combine all of this with supply and demand. So if you don't truly understand the profile right now, it'll be pretty difficult to get your head around the upcoming float charts and decision charts and what they actually mean. So get comfortable with the new terminology, and once you're ready, come back for the next lesson.